Welcome to today's deep dive analysis of GAIN, a brand new cryptocurrency that has captured attention across trading forums and social media feeds. In this video, we'll examine whether GAIN's rapid rise is the start of a genuine long-term trend or just another short-lived pump and dump. Our goal is to give you a clear, balanced perspective so you can make informed decisions. Please remember, nothing here is financial advice. Please do your own research before investing. GAIN launched only a few weeks ago, positioning itself as a decentralized finance token aiming to streamline yield farming and staking rewards. Its white paper highlights fast transaction speeds, cross-chain compatibility, and a governance model that gives token holders voting rights. While these claims sound promising, early-stage projects often paint an ambitious picture that can be difficult to execute in practice. A key question for any crypto project is transparency of the team. GAIN's founders are partially pseudonymous, revealing only first names and social media profiles. They state they have prior experience in blockchain development, but verifiable track records remain limited. For investors, limited transparency raises both regulatory and trust concerns, significantly in an industry where anonymous schemes have occasionally disappeared with investor funds. GAIN has a total supply of 1 billion tokens, with 20% allocated to the development team, 40% for community rewards, 25% for liquidity pools, and the remainder for marketing and partnerships. While the large community allocation can incentivize adoption, the developer allocation is relatively high, meaning a small group could exert significant control over price if they sell their holdings. Since launch, GAIN's price has experienced sharp spikes, rising over 300% in its first 72 hours before retreating about 40%. Trading volume has been equally volatile, swinging from near zero to several $1 million in daily turnover. Such rapid movement is typical of new tokens but also a classic sign of speculative trading rather than steady organic growth. Twitter, Telegram, and Discord channels dedicated to GAIN are buzzing with memes and to-the-moon slogans. Influencers with large followings have begun promoting it aggressively. While social media attention can drive adoption, it is also the perfect environment for pump and dump operations, where early buyers hype a coin to attract newcomers and then exit at a profit. Currently, GAIN trades primarily on decentralized exchanges such as Winswap and PancakeSwap, with no major centralized exchange listing. A lack of established exchange support limits liquidity and exposes investors to higher slippage and potential contract risks. Future listings on bigger exchanges could boost credibility. There is no guarantee those listings will happen. GAIN's smart contract code has reportedly undergone a third-party audit, but the auditing firm is relatively unknown, and the report has not been widely circulated. Without a well-respected audit or open-source code that the community can review, there is lingering uncertainty about vulnerabilities or hidden functions that could allow developers to manipulate supply or drain liquidity. In the DeFi yield farming space, GAIN competes with established players such as Aave, Curve, and Yearn Finance Latents that already have deep liquidity, proven security, and active governance communities. To gain a real foothold, GAIN must offer something dramatically better, cheaper, or faster than these incumbents, which is a steep uphill battle. Global regulators are increasing scrutiny of new tokens that promise high yields or exhibit speculative price swings. If GAIN is perceived as a security or if its promotional activities cross legal lines, it could face enforcement actions or exchange delistings. This risk is particularly relevant for tokens with anonymous schemes or unclear jurisdiction. Several red flags align with common pump and dump patterns: sudden price surges, heavy reliance on social media hype, and the concentration of tokens among a few wallets. Blockchain data shows that the top 10 wallets hold over 60% of the supply, giving these holders the ability to crash the price with a single coordinated sell-off. Despite these risks, GAIN does have potential if its technology delivers on cross-chain yield aggregation and if the team secures reputable partnerships. Early adopters of projects like Polygon or Solana also faced skepticism before proving themselves. If GAIN builds real utility and earns broader trust, its current low market cap could present a genuine growth opportunity. For those considering an investment, risk management is crucial. That means never investing more than you can afford to lose, using limit orders to manage slippage, and considering strategies like dollar cost averaging rather than lump sum purchases. Monitoring wallet concentration and liquidity levels can also help you gauge whether whales are quietly exiting. The GAIN community appears enthusiastic, but enthusiasm alone does not equal sustainability. The published roadmap includes milestones like multi-chain bridges and NFT integrations within the next 2 quarters. Achieving these goals on schedule would be a positive sign, but missed deadlines are common in early crypto projects. GAIN is an exciting but highly speculative play. While its promises of cross-chain DeFi innovation are appealing, the combination of anonymous leadership, concentrated token ownership, and volatile price action demands caution. Whether GAIN ultimately becomes a legitimate contender or fades as a pump and dump will depend on execution, transparency, and market adoption in the months ahead. Proceed carefully, stay informed, and treat any potential investment as high-risk capital only.